My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make a little money. My job's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The market did it again, darn it. We roared at the opening. Dow rallying more than 450 points from the get-go because this morning's consumer price index number came in soft enough to illustrate that inflation is finally running out of steam. So when the CPI came in around 3%, way down from where it was before, we all cheered. Many people bought stocks. Everything's fine, right? Wrong. That rally was a totally revolting development. Sure enough, the averages spent the rest of the session selling off. Dow finishing up just 53 points, while S&P advanced minor 0.03%. NASDAQ edged up 0.12%. A far cry from that overheated opening. There's so many reasons why it was a mistake to buy stocks at a strength this morning, and because I've been spending this whole week teaching you how to avoid the kind of mistakes that make you give up on the entire stock market, we're going to unpack this one, unpack it good. Mistake number one. The vast majority of people who follow the stock market closely were predicting that the consumer price index would be up around 3.3%. It was actually up 3.2%. Take note, when most prognosticators predict 3.3% inflation and you get 3.2% inflation, guess what? It's not a surprise. And you don't buy stocks aggressively on a data point that's not a surprise. That's right. Never buy into a phony surprise that the media hypes up for a faux bit of excitement. You will most likely lose money. Second mistake. If you buy stocks on this kind of bogosity, will you please use limit orders? Don't use market orders. Pick a price that you're willing to pay and put the order in using that limit. If you use a market order, you're at the mercy of your broker, and it's like the clowns who buy the stock futures with reckless abandon. Well, they will end up causing you to get a crummy price, probably the highest price of the day. Those who did it, you know you did. You did what we call top ticking. You can bet that almost every single person who used a market order to buy a stock this very morning is now down on those trades, and they probably want to sell everything and give up on stocks, because they're so mad at themselves for paying up. Market orders put you at the mercy of an unmerciful market. Stick with limit orders, and you won't wind up radically overpaying for stocks. You might miss them, but that's okay. I don't want you doing this and then throwing your stocks away. Third mistake, instead of buying at an up opening like today, maybe you should think a little. Maybe you use these moments of strength to look over what you don't like and sell. Maybe you have a health insurance stock, a pharmacy stock, an oil stock that's been straight up for days, as some of them have been. You should offer that stock up. Again, putting a limit order in that's nicely above where the stock closed the day before. And that's how you get out at a price better than you deserve. That's what you're always looking for. Remember, you want to sell into strength and buy into weakness, not the other way around. That's not the way it's done. Finally, when you get the inevitable intraday sell-off that I predicted in our morning meeting show at 10:20 when I speak with Jeff Marks for the Investing Club, you need to do some serious watching for when the tide starts going back out. Almost all the stocks that got taken up at the opening went down because there was nothing grounding the move to begin with, just futures buying. But if you can find a stock that actually starts to go higher into the wave of selling, if the future buying ends, I got to tell you something, that will be a winner. Today we had a textbook winner.
All aboard!
Walt Disney. When almost all the other stocks were in retreat from their highs, Disney stocks slowly, step by step, inch by inch, started to advance. Whenever you see that kind of action, you know that something special is happening, because this is a stock that's able to defy the gravitational pull of the average after being cut in half over the last couple of years. Now, I know this is not a trading show. Far from it. I'm almost always railing against short-term traders. It's almost impossible to pull off unless you're trading at a full-time job, and I'm not doing this show for full-time jobbers. But before I got to show, I did have 25 years of trading, and that's when I learned this simple rule. Look for stocks that can buck a strong future selling trend. If they can withstand that kind of sell-off, that tsunami sell-off, there might be something special going on that you got to focus on. That's exactly what happened today with Disney. Disney stock could buck the trend and finish up almost 5%. Because a bunch of good things are finally going on there. First, CEO Bob Iger delivered a quarter that actually looked pretty bad on its face. In fact, the stock got hammered down $3 on the headlines. But to be blunt about it, the people who were selling Disney were being morons. Disney does not have some sort of buffoon CEO at the helm. Iger's a seasoned veteran who's created a tremendous amount of value over the years. And if there's one thing he knows how to do, it's tell an electric story. So you need to wait for him to speak on the darn conference call before you take any stupid sell action. And those who didn't wait, they missed out on a fabulous run. Shame on you. What exactly did Iger say? Well, a bunch of things. He talked about better Disney Plus numbers, including some price increases, the possibilities of some strategic initiatives to get rid of the pain of linear television's decline and future fall. Filled up the cruise ships. Best of all, the balance sheet. The balance sheet. It's no longer in tatters. There's some optionality. Not long ago, I felt that Disney was cornered. Far from it. The stock started rallying as the call went on, largely, I believe, because Iger knows what the heck he's doing. He was actually pretty funny, by the way, as the Q&A went on. I know owning the stock has not been fun at all.
A house of pain.
Some might have found it hard to take the humor. I, on the other hand, found it reassuring. Many CEOs would be shaky. They'd be tense. They would even be brittle after such a hideous decline that this stock has had. Iger sounded in control. I think that's why the stock was able to mount a rally right into the teeth of the market-wide pullback in the first few hours of the day. Now, the sell-off was indeed like just a storm, which meant there was a huge amount of pressure on every stock. To be able to buck that storm pressure, there had to be a tremendous amount of buying power, a sign there will most likely be buyers at lower levels as Disney stock ever comes in again. I like that trampoline underneath. It almost always portends good news from the analyst community. When they see this kind of action, they think to themselves, aha, the stock's saying finally the worst is over. I better upgrade from sell to hold or hold to buy before it takes up. Before it just boom, without me. How do I know this? Because I've worked with analysts for years, and they're loath to call bottoms themselves. They like to wait until the market calls the bottom for them. That's what I believe happened with the stock of Disney today. But let's go back to that feeling of being picked off by the market's opening. When you see a huge up opening off a stupid, phony surprise, you got to remember that doesn't change the prevailing trend of the market. Right now, the prevailing trend is to sell the big capitalization techs. That's still going on. And buy smaller stocks or industrials with aerospace exposure particularly, or stocks of companies that right now do business in China because the Chinese government's back allowing groups to take tours again. It's viewed as a sign that the worst might be over. I can't call a bottom in China. Much too phony. But the bottom line, I can tell you that when you see the techs rally as part of a group move like we had at the opening, that's going to produce a rout later in the day when the market changes direction. And then you use that route to spot brand new spanking winners. Winners like the stock of Walt Disney. Paul in New Jersey. Paul.
Booyah, Jim, how are you?
Oh, Jimmy Chill is fine. Don't like the weather. What's happening with you?
That's awesome. Three-time caller and a very happy club member.
Yes, that's what I want.
Yeah, I just want to thank you and your staff. I've learned so much from the club. It's definitely making me a much better investor, and I really appreciate it.
Oh, thank you, man. Thank you very much. Thank you. That's what we want. That's why we do it.
Awesome. All right, the past couple of nights, you've been talking about pipeline companies. Now, I have a small holding in Kinder Morgan. I've had it for a while. I'm in the green. It pays a nice yield, but it's kind of stuck.
It is stuck.
Or should I bail and hit the Enbridge?
Well, candidly, it's not one of my favorites. I had One Oak on the other night. I thought that was a better stock. And I've got to tell you, I think Enbridge is a better stock. And I can't believe I'm about to say this, but I am going to say it. Energy Transfer, yes, ET, phone home, is a better stock than Kinder Morgan. Sally in New Hampshire. Sally.
Hey, Jim. Boeing's been around for a long time. When are they going to reinstate their dividends?
Well, Boeing is safe. Boeing is good. Cramer doesn't own Boeing for his charitable trust and feels awful. Got cowed when it just stayed down for so long. That was a mistake. But a very nice club member earlier, Paul, said he's thrilled with what we do in teaching. Here's some teaching. I blew out of Boeing too early and swapped into other aerospace plays. All right, listen to me. I can tell you that when you see the techs rally as part of a group move like they had at the opening, that could probably produce a rout. But in that rout, what you can do is find winners. And the winner is the Walt Disney Corporation. Made money tonight. We know this FTC isn't two kinds of mergers, but I spotted one that managed to get approved that I think will present a buying opportunity that nobody really likes. I'll reveal what it is. Then the ESPN Penn Entertainment deal sends shares of DraftKings sharply lower. So are investors getting a buying opportunity in the online sportsbook, or will Disney and Penn Entertainment annihilate them? I'll give you my sense of the situation. And Ralph Lauren's stock pulled back after earnings. So are investors finally getting a chance to buy the apparel powerhouse, which has been doing so well? I'm going to dig into the story with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.